Previously communicated, all requisite processes have been successfully completed, culminating in the creation of Aditya Birla Lifestyle Brands Limited. The company was listed on the stock exchange on 23rd June 2025. Coming to the financial performance for this quarter, ABFRL sustained its strong profitable growth momentum in Q1FY26, underpinned by a well-defined strategy of scaling its diverse, high-potential businesses with a disciplined focus on profitability. The company's consistent execution once again delivered healthy top-line growth alongside margin resilience despite a challenging market backdrop. Revenue for the quarter increased 9% YOY to rupees 1,831 crore, fueled by strong performance across key segments. Performance of ethnic and tomorrow business stood out, delivering 25% and 38% growth respectively, reflecting the strength of their brand portfolios, expanding consumer reach, and sustained demand momentum. EBITDA rose to 169 crore, up 38% YOY, supported by strong expansion in the ethnic business, where margins improved by 600 bps. Stable margins in tomorrow and Pantaloons, despite a softer market environment further impacted by the shift of Eid. Excluding tomorrow, the rest of ABFRL portfolio delivered an EBITDA of rupees 245 crore, which is 49% growth over last year. This balanced growth, driven by both scale and operational efficiency, underscores ABFRL's ability to navigate market shifts while building a stronger foundation for sustained profitability. As of June 2025, ABFRL held gross cash of 2,070 crore. Let me first cover Pantaloons. The Pantaloons segment reported revenue of rupees 1,094 crore, primarily due to the shift of Eid and the impact of store closure over last 12 months, adjusted for which growth would have been 4%. L2L this quarter remained flat. However, when adjusted for the shift of Eid from April last year to March this year, the normalized L2L stood at 3%. For Q1FY26, the segmental margin stood at 17.1%, marginally lower than last year, largely owing to lower sales. Despite this, Pantaloons format once again delivered an EBITDA margin of 18% plus, underscoring the consistent strength of its retail operations, controlled markdown strategies, and disciplined cost management across its network. Style Up, the value retail format under Pantaloons, continued its strong growth trajectory. The brand expanded its footprint to 49 stores during the quarter and posted a robust 36% revenue growth, signaling expanding shopper base. This momentum positions Style Up well for accelerated scale-up in the coming quarters and sustained growth in the years ahead. Ethnic businesses, our ethnic wear business continues to be a powerful growth engine for us, anchored by the most comprehensive ethnic brand portfolio in India, spanning designer-led brands to premium ethnic wear brands. In Q1 FY26, the segment delivered a stellar performance, reporting revenue of 436 crore, up 25% YOY, one of the highest growth rates across our portfolio. Profitability saw a sharp uplift, with EBITDA margin expanding by 600 bps, resulting in positive EBITDA this quarter versus a loss in the same period last year. The quarter's strong performance was driven by robust L2L growth across most brands, with occasion-led brands posting double-digit L2L growth on the back of a strong wedding season and sustained demand for occasion wear fashion. Strategic actions, including curated seasonal collections, sharper merchandising, and enhanced retail experiences, further strengthened consumer connect and translated into higher productivity per store. Our designer-led ethnic portfolio, comprising Sabyasachi, Tarun Tahiliani, House of Masaba, and Santanu Nikhil, delivered an exceptional 79% YOY growth in Q1. These brands continued to set benchmark in the luxury and pret ethnic space, driven by category extension, accelerated store rollout, and continuous product innovation that elevated consumer experience and brand desirability. Within premium ethnic wear, Tasva posted another standout quarter, capitalizing on the wedding season to deliver 72% YOY sales growth and 39% L2L growth. The brand further deepened its presence in key wedding hubs and strengthened its connect with Indian consumers, expanding its network now to 70 stores. TCNS posted growth in revenue over last year despite store closures, demonstrating the resilience and strength of its brands. Growth was multi-channel, led by 4% retail L2L alongside strong momentum in other sales channels. After a slow April, business has moved into a consistent double-digit L2L growth trajectory. Profits of the quarter saw a significant improvement versus last year, driven by higher gross margins and improved retail performance. On luxury retail, comprising the multi-brand format The Collective and other mono brands, continue to deliver double-digit profitability, posting single-digit YOY growth in Q1 versus last year. The format added 3 new stores to the network and now encompasses 54 stores. Now, Tomorrow portfolio grew by 38% versus last year's this quarter. This strong organic growth was fueled by an expanded product portfolio, enhanced focus on D2C channels, and impactful brand building initiatives. Portfolio brands accelerated their offline expansion and exited the quarter with 25 stores across key markets nationwide. The current fundraise will position the brands well to continue to keep this high growth momentum and realize our ambition of building multiple large digital first brands. In conclusion, this quarter's results underscore ABFRL's ability to achieve profitable growth, marking the 4th consecutive quarter of year-on-year margin expansion. This reinforces our confidence as our emphasis on innovation, retail productivity, and disciplined cost management has strengthened margins and maintained resilience even amid a cautious demand environment. Going forward, we'll continue to scale our core market-leading brands while accelerating momentum in our newer high-potential segments. With the festive season arriving early, we are well positioned to capture demand through compelling product stories, enhanced retail experiences, and a wider omni-channel presence. Our strategy remains clear: build on the strength of our brands, sustain profitable growth, and create long-term value by staying ahead on evolving consumer preferences in the Indian fashion and lifestyle space. We are open to questions now. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star and then 1. Our first question comes from the line of Aditya Soman from CLSA. Please go ahead.
Hi, good evening and thanks for the opportunity. So 2 questions from me. Firstly, on the sort of very strong EBITDA trajectory for the ethnic business. So we've seen strong growth and now for EBITDA also improve. So can you give us some sense of how you see this trajectory evolve over the short term and then more importantly over the medium term, and where you feel steady state EBITDA for this business should be? And then secondly, for the Pantaloons store closures, so there was a sort of a 2.7% store reduction, but I see that the area is actually flattish. So one, anything to read across in that? And secondly, would this represent sort of the norm? In a normal, would we still see further store reduction, or do we think for now we are good in terms of store count and we could potentially see an increase down there?
Thanks, Aditya, for those questions. On the ethnic portfolio, I would first say that there is consistent improvement across the portfolio of the brands, but we have a mix of brands which are well established, highly profitable, brands which are in the turnaround phase, like TCNS, and the brands which are in build-up phase, like Tasva. So the first part is most of these businesses benefit from wedding seasons, which is largely in the second half of the year. The cost base remains pretty static, but the revenue is significantly higher in the second half versus first half. So you will see a much sharper increase in profitability as we move towards the second half of the year. Having said that, the three constituents, which is designer brand, the turnaround business of TCNS, and Tasva, will all have different trajectory. I think designer brand portfolio is quite stable. I would argue in high 20s in post-Ind AS terms to some of them in high 30s is really where the steady state margin will fit. The premium brand portfolio, which is Tasva, is still scaling up. You can see the quarter performance, 70-odd% growth, 39% like-to-like. I think we'll continue to push it. Profitability is somewhat away as far as this business is concerned. We think FY27 end is where we'll get to the break-even in Tasva. TCNS has been showing strong improvement, but still, while at the post-Ind AS level it's turned positive, at pre-Ind AS terms it's still somewhat below the break-even level. I'm very enthused by the turnaround trajectory in TCNS and the acceleration in Tasva, while the designer brands by themselves are already in good space. As a portfolio, therefore, Aditya, if you look at it, ethnic wear business, which we had zero presence till FY20, we now have a business which was last year close to 2,000 crores, growing this quarter at 25, but I would say even going forward, one could imagine a 20% kind of growth rate. And as TCNS kicks in, perhaps that could be even stronger. And at portfolio level, a post-Ind AS EBITDA margins north of 20% is what we could look at as far as this business is concerned. We're not there yet. There is also seasonality between first half and second half, but that's really where we think the ethnic business. So it's a very beautiful business shaping up extremely well, both in terms of size and profitability. On your second question on Pantaloons, we did a fairly deep network correction if you have followed the business over the last 15 to 18 months from a network of stores which is north of 460. Now we are talking closer to 400, and much of it has happened in the last 12 to 18 months. I think we've hit the bottom end in terms of store closures. You're going to start to see net store additions as we go forward. The new store, in line with the strategy that Sangeeta had sort of laid down, is about opening larger stores. So while the number of stores may be fewer, the size of the stores will be more like 20,000-25,000. If you see any of our new Pantaloons store, it's cleaner, bigger, more impactful, and very modern and contemporary. Some of the visuals you can see in the presentation itself. And that's the direction for Pantaloons, which we've been consistently following as a part of our repivot, which we started 2.5 years back when we made the correction in distribution as well as imagery of Pantaloons.
No, understand, very clear, and thanks for that detailed answer. Just maybe one follow-up on Tasva. Obviously, growth here is very strong, but when we sort of look at when we say it's available across 70 stores, this includes these are just standalone Tasva stores, or these are also other?
Absolutely, no. That is just standalone Tasva stores.
Understand. So the LTL is just this 39% is on the standalone Tasva store versus standalone Tasva.
Yeah, about
right?
52 of these 70 stores would be part of the LTL base.
LTL. Perfect. Oh, that's very helpful. Thank you.
Thank you. Our next question comes from the line of Archana Menon from Morgan Stanley. Please go ahead.
Hi, sir. Thank you for the opportunity. My questions are on Pantaloons. Firstly, on the marketing and brand building side, what is the spend currently as a percentage of revenue for Pantaloons, and how has that been in the past? Are we thinking of taking that up, in this year and the years to come? And the second question was in the retail identity. There's a mention of the new retail identity and some pictures. But just wanted to get a sense from you that of your total 400 odd stores, what percentage of stores would we say under the old retail identity, which maybe you're not so happy with, say maybe 5 years earlier. So what is that percentage, and how are you thinking of refurbishments and renovations going ahead?
Okay, so Archana, as far as Pantaloons marketing spends are concerned, they have been in the range of 1.5% to 2% historically. At its peak, maybe 2.5%. At the low point, maybe 1.5%. But typically 1.5% on an annualized basis. Of course, quarter and quarter, these numbers look very different. But on an annual basis, I think you could assume a 1.5% kind of base as the number that we have. We expect in a shorter term, which is next year or so, this percentage to marginally go up, primarily because we feel we now have a new proposition. The Pantaloons stores, the product portfolio, the aesthetics, the design cycle, everything that now is represented in the new Pantaloons is a big shift from what we used to be. So every element of innovation, aesthetics, retail display, the consumer experience has significantly moved. So towards the festive part, we may spend a little bit more for a short period of time. I don't think it will change the long-term sort of investment of 1.5-2% kind of range. It won't be any different, but a short period of time you might see in some quarters some of the more targeted spends, typically closer to the festive period.
Retail ID.
On the retail ID, it's been an evolving story. The latest retail identity that we are talking about is obviously very, very new, but if I were to count the last one or the ones that we are very happy with, and it's modern and contemporary and in line with the current position, about 50% of our network is of the new identity that we are happy with. There is a task in the remaining 45-50%. We will take it slowly over a period of time. Not all these stores are based in big cities where it's required as those cities are experiencing better retail environments far more rapidly. So we'll pace the rollout of new retail identity and take it over a 3-4 year period.
Understood. Just two follow-ups. Firstly, if you could just help me with the city presence for Pantaloons now after all the store closures. And secondly, for tomorrow, after the fundraise, what would your stake be right now?
City, about 185 cities is where our presence is, 185 to 190. And is that what you're looking for, or are you looking for any more granularity than that?
No, sir, this is good, 185, 190.
Okay.
And on tomorrow, on your stake currently?
So tomorrow, it's an early double-digit stake that ServiceNow Ventures has invested in for their 423 crores. It's 11% kind of stake. The exact details are probably in the filing, but that's a rough stake that they have. The remaining stake lies between ABFRL and a small part within that in the ESOP and employees.
And so this last question, so what would your current investment be in tomorrow so far?
So tomorrow we have invested 770 crores through equity investments in different forms over the last 3 years. 3 or 4 years.
Thank you so much.
Thank you. Our next question comes from the line of Kunal Shah from Jefferies. Please go ahead.
Hi, thank you for the opportunity. So my question is also on tomorrow. So with this capital raise, your cash burn in this business is not that high. What are the areas where this will be invested? Are there more acquisitions planned or offline expansion, or how would this capital be allocated under tomorrow?
So, Kunal, two parts. One, capital raise process is still on. We expect to raise more capital in this round. The first announcement you've seen, but as I've always maintained in our previous calls, we are looking to raise close to or north of $100 million. It's half of that capital. Where would this be used? You're right. There is a part which will go towards the funding of the businesses, since it's still not cash flow positive or EBITDA positive at this stage. So first part of it, our focus currently is on growing what we have. We have a portfolio of very powerful brands. Some of them, when we acquired, were as low as 10 crores a year and have grown from 100 to 200 crores a year. Some brands were 200 crores have grown to 300 crores. Some require acceleration. Some requires more branding effort. But by and large, it's for acceleration of growth of this businesses where the capital will go. As you would have seen in our presentations, the CBO expansion, because we want to truly build an omni-channel, digital-first experience, but omni-channel for our brands. Our brands such as Bewakoof, the India Garage Company, Nobero, etc., have started expanding offline. Wrong had already had some presence. So there would be a part of capital that would go towards that.
Understood. And the second question is on TCNS. So if I heard it correctly, you said after April, this business is moved to a double-digit like-for-like growth. Is that understanding correct?
Yeah. So this business, as you know, had been struggling to get organic growth for some time in past. But in last 4 months, 4-5 months, we've changed the trajectory. Only April was affected to some extent. And that was also partly due to shift of Eid. But if you leave that aside, every month is delivering good, strong, high double-digit like-to-like growth. And that's a very assuring for us because a lot of changes have been done in merchandising. Retail execution has been significantly revamped. The old inventory is out of the system. Poor stores are out of the system. So we are finding a very strong trajectory, and therefore our thesis on investment in TCNS is looking much more surer and stronger now at this point versus any time in the last 12 to 18 months.
Understood. And if I may get this data on what is the percentage of revenue that this, or what is the percentage of revenue coming from retail which this LTL growth captures, if I can have some understanding of that. And in the other parts, the other channels, are you looking to consolidate or has that already happened and is that is behind?
So it's north of 50%. I'll just figure out if there is significant deviation, the retail share. Yeah, it is about 50-odd%. Department stores and e-commerce constitute the large part of the remaining business because the MBO business is very small. I think the business is now well positioned with everything that needed to be sorted out to even grow in department store channel, which had stagnated over a period of time in the last 1 or 2 years while we're fixing the product. I will see growth coming there also in next couple of quarters, as well as online business. Although online business as an overall business is only about 15-18%. But I expect the share to rise as far as online is also concerned.
Understood. And any plans to expand store network now again in the retail channel, or that is still some time away?
So Kunal, as we had mentioned, a part of our strategy was first to remove bad inventory, bad costs, and bad stores, which we did in first 8 to 12 months. Then was to revitalize the merchandise as well as revitalize stores, which is what is executing, and we are very happy to see the kind of outcome that it's delivering in terms of same-store performance. As we move towards second half and perhaps towards the later part of this year is when the expansion would start. The real impact of that you'll start to see only next year.
Understood. And in that case, pre-index profitability also should come next year, probably on a full year basis.
Yes.
Understood. Thank you. That's all from my side.
Thanks.
Thank you. Our next question comes from the line of Gopal Nawandar from SBI Life Insurance. Please go ahead.
Hi, sir. Thanks a lot for the opportunity, and congratulations on this external fundraise for tomorrow. So my question was on, we have seen improvement in the profitability of TCNS. So when we should start seeing the addition of network in TCNS?
Gopal, thanks. As I was explaining to Kunal, we want to be sure that business is in good place, product is working, stores are working, the viability is strong. So in last 4, 5, 6 months, we have started to see the outcome of it when the like-to-like first moved from negative to positive and now moved from positive to double-digit positive. This gives us a lot of confidence. Of course, store pipeline takes some time to build. So you'll start to see perhaps second half of this year, you might see 30 to 40 store addition. But next year onwards, if this trajectory continues, we're very confident that this improvement is quite structural and strong. We'll start expanding more rapidly next year. We may start to do it towards the second half of this year, but most of the benefit of that will probably come next year.
Okay. And Pantaloons side also, we have seen consolidation of network. What is our plan there in terms of will there be a network addition this year, or will still continue to reject the sizes of the stores?
So I think in absolute number of stores there may not be significant addition, but the network is improving both in quality and size. Number of stores that we are opening between 20 to 30,000 is where the focus of new Pantaloons is. A lot of our network of small stores is what we are looking to rationalize. This year there may be only marginal increase in network, although the space increase will be material. But going forward, I think Pantaloons has bottomed out its stores that we wanted to close, and we expect next year onwards to start adding to the store network as well.
Okay. And sir, on the tomorrow side, losses in this quarter was little higher versus what has been the run rate in last few quarters. With this fundraise and our focus shifting more on the offline stores, how should one see the profitability trajectory for this business?
So you're right, Gopal. I think the quarterly performance, while they're on the revenue side, was very strong with 38% organic growth. The losses had marginally gone up. In percentage terms, they were similar to last year, but in absolute terms, that has gone up. I think in second half of the year, we will see that trajectory also beginning to change. Fundraise will, of course, be put for also expanding offline business to get the balance between offline and online. Offline businesses, the benefit, Gopal, it brings is brands which are seen only online, the credibility comes and stature comes from offline presence. Offline business also allows us to typically increase the gross margins by higher price points, superior products, which sometimes get lost in online business. So we are finding almost a 10 percentage difference, 1,000 percentage point difference between the gross margin that we deliver in offline business versus the online business. But still, the share of offline today is small. As it improves, the shape of profitability will start to shift there.
Okay. And sir, can I ask questions on ABLBL in this?
We would probably, Gopal, not be able to address that in this call, but we will reach out to you separately for any question. Amit will connect with you.
Sure. Thanks a lot and all the best.
Thank you. Thank you, Gopal.
Thank you. Our next question comes from the line of Harsh Shah from Bandhan AMC. Please go ahead.
Yeah, hi. Thanks for taking my question. And so basically, Ashish, just like even Style Up will be right in the investment phase, I would believe, right? And while you kind of laid down your ambition for Style Up over a 5-year period, would just want know probably what would I mean your kind of store opening guidance for next couple of years. Let's say what would that be, and currently at what revenue per square feet? Let's say the initial cohort of stores, right? It might be 10, 15, 20 stores. What revenue per square feet basically are they operating at currently?
So I think our projections for Style Up, we have mentioned our long-term plan. We currently have about 59 odd stores, 50, 55, 60 stores, 49 stores at this point of time. We look to add about 40 stores this year, which will increase the size of the business, and the productivity has been varying between we if you look at sales per square feet per day, between 20 to 25 in some of the lower performing stores to 35 to 40 in some of the higher performing stores, depending on the location, the kind of market that it is. It needs to go up from there, but at current level of performance, the store network as a whole is profitable, which means the contribution at the store level is positive for the entire store network of 4950 people, 50 stores. As we scale, get some leverage of scale, both on the gross margin as well as visibility of the brand, I think that's where the positive flywheel will start to set in.
So there is basically at EBITDA level, there is no cash burn in this format as well.
So there is a cash burn at EBITDA level to cover the overhead cost of the operations.
Corporate overhead. Okay. So format level, basically, it's EBITDA positive, but let's say corporate level, it's still...
Retail store level is positive, but the corporate overheads are not covered.
Okay. When would the peak losses be in basically in this business at EBITDA level? And when do you foresee at what level of scale? 100 stores, 150 stores, or...
See, I think we'll discover it perhaps in next 18 to 24 months, because if this rate continues, which means as we add more stores, the store losses are not there. And therefore, we have a higher leverage available to fixed cost. But we also recognize that on the other side, as you scale the business, you'll have to also increase your team size, operations. So fixed overheads will also grow at this point of time. So maybe for next 2-3 years, we will have some level of losses at this point of time, because overheads we may have to increase a little bit more ahead of actual expansion. And that's the period we'll go through. But I think both the size of the opportunity as well as the current performance gives us confidence that it's a fairly scalable business, and therefore leveraging of overheads is something that we'll be able to achieve in maybe 3-4 years.
But is there a case basically where you see to kind of accelerate this store expansion? Because at current scale, I'm looking at what the other players are expanding. Probably 40 stores looks probably slightly on the lower side. Is there a possibility that given the confidence that you have in the store format and store level profitability, this can go up to 60-70 stores or something of that sort?
So very easily, and certainly. I think we just want to, I think the only point I would make is that it's a very large opportunity and a market which provides a very long-term growth piece. We don't want to rush into it, because this will be an opportunity not just today, but in FY30 and FY35 also. And therefore, we are equally focused on making sure that we get it right, continue to refine the proposition, improve the product, while simultaneously growing this year at 45-50 stores, but after that between 75 to 100 stores is pretty much on card.
Got it. And one on Sabyasachi, I mean, at least for this quarter has been fantastic, but if we look at the last couple of quarters, Q2, Q3, probably the growth rate had tapered off. So what really changed in this quarter which led to such high growth? If you could give some qualitative color on it, would be helpful.
No, I do think his growth rate last even the quarter before, which is quarter 4, was fairly stable. Good growth rate, of course, not like 40%. See, remember, all wedding wear businesses Tasva at 72% growth, Sabyasachi whatever, close to 40% growth, Tarun Kalyani, all the businesses have also benefited from a low wedding base of last year. To that extent, this is not the organic growth number. This is a reflection of a lower base, and which is to some extent is what is showing up in anybody who has a share of exposure to wedding-related purchases.
Okay. Got it.
I don't think, however, there is any absence of growth momentum in the brand. It's a very, very powerful brand. Obviously, it's a brand which you don't want to rush in and grow like we may want to go with Tasva or Style Up to that extent. But the brand trajectory will continue to grow extremely well.
And has the contribution of, let's say, jewelry in Sabyasachi increased meaningfully, let's say, on a YoY basis? Or, let's say, between jewelry, apparel, and accessories, let's say, press label, what they have. So, has the contribution been stable on a YoY basis, or is it more like driven by apparel or something?
Jewelry is a category in which Sabyasachi's brand's share has been growing consistently over a period of time. It's a very large category, and Sabyasachi brand as well as Sabyasachi himself is spending a lot of time in refining the proposition, taking it very high end, because no Indian jeweler has reached the level of pricing and sophistication that he has, not just in India but outside. But obviously, compared to the size of the market in jewelry, it's a small business. But as a part of his mix, it's a meaningful mix now and growing as a share of the overall portfolio.
Okay, got it. And just one more, basically on Tasva, what will be the store addition plan this year? And also gross cash is 2,000 crore, but what is the net cash currently with us on 30th June?
So, Tasva store addition plan is about 40 stores this year, plus minus a few, but that's really the total store addition plan for this year. On the gross to net cash, there is debt lying in tomorrow, and there's debt lying in standalone entity, and there's debt parts of the ethnic subsidiary. So Jagdish can
See, Harsh, with us at standalone level, I have cash of around 1900 crore and a borrowing which is 750 crore for this is long term, falling due in 29-30.
Okay.
We have adequate cash for the future expansion plans.
That remaining is on tomorrow, which also will get offset by the current fundraise. So that number will move significantly post this fundraise.
Yeah.
And there is debt lying in some of the ethnic subsidiaries.
Like Sabya and others. Yeah.
Okay, but not meaningful, right? I mean, if you could quantify that, the debt in the subsidiaries, ethnic subsidiaries.
That's maybe another 600 crore. I don't know. Yeah.
Without tomorrow.
Without tomorrow is not more than 200 crore.
So about 200 odd crores lying in subsidiaries.
Ethnic subsidiaries.
And tomorrow, of course, will again turn net positive because the debt currently will be offset by the equity raise that we're doing.
Okay. Got it. Thank you so much.
Thank you. Our next follow-up question comes from the line of Kunal Shah from Jefferies. Please go ahead.
Hi. So my follow-up is on this tomorrow capital raise. So just want to understand this 11% dilution would imply, I think, valuation of around 4,000 crores, right? So is there any performance benchmarks, or is this valuation independent of all of those things? Or given it's in a CCPS form?
This is like a regular equity invested in investment in form of CCPS. No, there's no sort of, if you're seeing is there any strings attached to it? No.
Understood. And if you include the brand which is not consolidated, I think one of those, the total revenue would be around 1,000 crores, right, for this business?
So last year, as we keep, I think last year annualized revenue would have been close to about 1,000 crores if we were to add wrong business to, which is where we currently have minority stakes. and it's growing at about 30-40%. So we expect the run rate to be closer to 14 to 1500 crores by the end of this year. But at this point of time, without consolidation, our revenue was 670 crores, which is 650 crores, which did not include wrong revenue, which would have been another 200 odd crores. So we would probably be about 850-900 crores last year revenue, and if you were to consolidate to wrong.
Understood. That's clear. Thank you for that. That's all from my side.
Thank you. Our next question comes from the line of Gaurav Jogani from JM Financial. Please go ahead.
Thank you for taking my question. So my first question is with regards to the CapEx. What kind of CapEx are you looking for this year and the next couple of years?
So I think at this point of time, we have regular CapEx for most of the businesses and a one-time CapEx. The one-time CapEx, I would say, is what we are completing this year for Gallery Lafayette store, the store which is likely to open towards the end of this year. So that's one-time CapEx. If you exclude that, I think the overall CapEx plan for other businesses put together will be in the range of about 300 odd crores.
Sure. And if we add the Gallery Lafayette, it would be 500 crores for this year. And
Yeah. That's for this year. Yeah.
Okay. So my second question is in regards to the losses that we are seeing in the tomorrow business. Though that number has increased, but I think the EBITDA also constitutes of the losses of wrong in that. Am I correct in my understanding?
Yes, we
Not fully.
Share of our losses. We consolidate in losses, although we don't take it in revenue. So it is inclusive of that. Yeah.
Okay, so in that is also one of the reasons why the losses seems to be higher Q2 in that context.
Yeah.
Okay. And sir, with regards to again tomorrow, what would be the final game plan here? I mean, though I understand that it will be in a high aggressive expansion mode, and which is something if you want to expand the group further. But when can we see at least a post-Ind AS break even here in this format?
So tomorrow, there's not too much of a difference between post and pre-Ind AS numbers. There's some, and as we increase the share of offline, perhaps that may grow over a period of time. As we have indicated in our investor presentation also, which we made beginning of this year, tomorrow we are looking at FY29 as the year in which we would try to look at EBITDA break-even. So that's the journey that we should be on.
Okay. But given the performance in terms of the top line growth, etc., is encouraging, do you think that it could be sooner versus what you would have expected earlier than that?
No, honestly, I don't see that. I mean, we will be happy to get there, but at this point, I wouldn't want to indicate that.
Okay. And around Pantaloons, the Pantaloons bit, we are seeing, that there is some losses because of the sign-up business there as well. And I mean, X of that and X of the marketing spends, ideally you indicated, that the profitability would have been higher. So once, Style Up also starts to contribute profitably, what kind of margins then you expect in Pantaloons to deliver on steady-state basis?
So if you were to stay with post-Ind AS and then we'll come to pre-Ind AS, I think Pantaloons itself is currently and consistently operated about 18% plus EBITDA margin. Style Up is obviously taking away, while it's marginally positive, but it's taking away. Therefore, the segmental results are close to 16-17%, depending on which quarter you're talking about. This quarter it was 17%, previous quarter it was 15%. So I think that's the range in which the current profitability is operating. We don't think we have achieved right level of profitability in Pantaloons itself, and we think another 300 to 500 basis point improvement profitability, whether you look at pre-Ind AS or post-Ind AS, is really what we need to deliver in Pantaloons. Style Up will start from a lower base. In pre-Ind AS terms, it will go through a loss phase, which is what it's going through. But the encouraging part is that loss will not grow rapidly with the network because the network itself is not losing money. And I think as we bring scale and create greater sort of brand visibility through supply by more stores, etc., we expect to improve that performance. But it will continue to remain loss-making for at least next 3 to 4 years, but not at a very high level of losses.
So, but then you said that the original Pantaloons would see some 300 to 500 bits from that level, and then we have to blend the losses. So that means we have to look into it. Okay. Thank you, that's all.
Thank you.
Thank you. Our next question comes from the line of Sameer Gupta from IIFL Capital. Please go ahead.
Hi, and thanks for taking my question again. So firstly on Pantaloons, it's been some time now that we've been hearing about the new identity that has been rolled out. I heard on through this call that around 51% of stores are now on the new identity. So let's say the top end of these stores, maybe they have spent around 2 years under this new identity. Any performance metrics you can share here, same store sales growth, the revenues per square feet kind of metric that they are tracking, are they on the right track? Is this strategy showing results? Anything that you can, highlight on that front?
I think I would say, the answer to your question is very simple. If you look at Pantaloons as a business, it was FY23 when we started the journey. It was operating at a margin of 14 to 15%. As we speak today, you can look at last 8 quarters. We are operating at 18%. So is the strategy working? Yes. I don't want to get into specific store level slices. I don't have it at this point of time, but I can also reconfirm to you that the new stores, the better stores, are performing better than the old stores, and that should be natural. But eventually, the outcome of it is showing up in the absolute numbers that we are talking about.
Got it. But internally, do you slice it?
We look at it. We look at it, but we look at it every store level also, because what happens for me is sometimes the location, its potential, all that also matters in coming up with numbers. So sometimes averages miss out the bigger picture, and 400 stores is not too many stores, and we are looking at 40-50 stores that we're converting into new identity, either through new store addition or through renovation. So it's a number which we very closely track.
So, Ashish, the point I'm trying to make here is that margin improvement is great, but Pantaloons, if you look at it over a longer term history, we have been able to improve margins and ROCE profile. The only problem area that I find is that there is no real history of same-store sales growth on a consistent basis. And with this new identity rollout, if that problem is still persisting, then it's a problematic area, right?
See, I think for us the more important thing is to figure out profitability. If we figure out profitability right, I won't worry about other pieces. So the intermediate metrics don't define the end outcome. Does every retailer need same-store growth? Absolutely right, Sameer. Is Pantaloons delivering it? I think for quite some time it's not been managed. It's not managed to do that. However, it's a journey, and therefore as you're seeing it, we'll hopefully start to get that. Sometimes where some are lead factors and some are lag factors. And we're beginning to see some of this starting to show up in a network. And the total numbers for same-store growth will take longer to show up as the share of these stores increase over a period of time, as many of these stores are also, remember, new retail identity are new stores. They will also increase their share as the number of such stores go up from current, let's say, 45% of network to 60% to 65% of network. But indeed, that's the holy grail we are trying to chase, which is getting to the same store growth, and completely agree with you. That's something that Pantaloons has not delivered consistently for some time.
Great, Ashish. That's great to hear. Second is on Tasva. Now, I understand you mentioned 40 store additions this year is what the target is, but if I look at more recent history, we've been very slow in terms of store expansion. We were at around 57, if I remember, by end of March last year, and right now we are at 70. So is this a conscious strategy that we just look at the first 50, 55 stores as a pilot and, be conservative in terms of store additions and then scale up, still trying to figure out store economics?
No, I think we've gone past the stage of questioning the viability or figuring out the concept. If you see any of the Tesla stores now, you get a sense of fairly established concept. We obviously want to be careful. It's a category which has very high seasonality. We are not opening 2,000 square feet stores. If you look at Plus, but for few malls, most of the Tesla stores are fairly large stores in fairly well-established markets, which means large rentals in absolute terms, both the rentals into size. And therefore, we want to remain cautious. This is a market which is available for us over a long period of time. As we had mentioned, our goal was to get 200 odd stores over the next 3 years. Currently, 40 is perhaps not the right level. So we are currently likely to go closer to about 90 stores by the end of this year. Hopefully, we'll be able to expand that a little bit faster, but don't want to do it in a hurry. It's not a value format which you can scale up very easily, and by and large, you'll get enough customers at that price point in any locality. It's a bit of a destination shopping. It's important to get the right store, right location, right facade, and that's taking somewhat more time than what we would ideally like. But from the concept per se, the retail viability, there's no question around it. I think it's a format which is working very well.
Got it. This is very, very helpful. Last question, if I may squeeze in, and it's related. So now, Tasva, you mentioned it is a more measured strategy in terms of store expansion. Pantaloons, in any case, 15 stores around you're targeting, so there also you are measured. Designer brands are anyway self-sufficient. TCNS is on the path to profitability. Tomorrow, you expect losses to come down from second half. So, and you are still sitting on a decent amount of net cash. So what was this, need to raise capital in Tomorrow at this point? I understand there is a trajectory of losses that you foresee in the coming years, but at this juncture, why, did you get to this capital raise?
So, Samir, I think if you look at absolute cash in the books and the businesses need cash, your question is absolutely valid. But I would also remind you that we have been fairly consistent about our philosophy of capital allocation and in various businesses. When we launched Tomorrow in 2021, we talked about that initially ABFR will fund it, give it some level of investment, allow the business to come to a certain size, and we will get investors, external investors. And over the next 8-10 years, build a company which can find a very digital native path to this industry, which is fashion industry, and have its own public market journey as we go forward from private to public. And in line with that, we had stayed with stating, even in the last fundraise, we had called out that the capital will not be used for Tomorrow, because Tomorrow has its own access to capital and potential attractiveness for investors because of its high growth trajectory. And that's exactly what we've got played out. So this is pretty much what we said 4 years back, 2 years back, and 6 months back.
Agreed, Ashish. This is very, very consistent to what you have been saying. But isn't the message going then that you're not very confident of the scale-up future of Tomorrow versus the other brands, because there are other brands in the portfolio which are loss-making as well?
No, but for Tomorrow we created Samir as a separate company 5 years back, and we have consistently stayed with exactly what we said then, now, and as I said, this is our strategy. When we play out our strategy, we will stay with what we had said. There's no reason to change it dramatically. So I don't understand where your question is coming from. When It was clearly stated in our capital allocation principles, which we laid out 6 months back, which we laid out 4 years back also. And this has been our strategy. So
that answers the question. Thanks again for taking these. I'll come back in the Q&A follow-ups.
Thank you.
Thank you. Our next question comes from the line of Jignanshu from Bernstein. Please go ahead.
Yeah, hi. Thank you for taking my question. Ashish, I know we discussed a lot about Pantaloons. I just wanted to get clarity on one thing. This new rebranding exercise that we want to do, and probably in general, our quote-unquote turnaround approach for improving the same-store sales growth at Pantaloons to recover our rentals, etc. What are we changing with this new identity? Like, what are we solving for? Is it more premium experience and hence better margins? Is it a larger variety? Is it just the look and feel to differentiate it or modernize it? I think that would be helpful to understand. Thanks.
Okay, Jignanshu, first I would say that while you're calling it new retail identity, there's no rebranding. It's the same Pantaloons brand being prepared as times change, the retail experience change, the landscape is changing. International brands are creating more aspirational retail environment. New retailers are coming, so this is in keeping with the times. This is something that retailers around the world do when the markets are evolving. In Western mature markets where the maturity has already been reached, this happens once in 7, 8, 10 years. But in a country like India, which is still evolving, consumers experiencing differential levels of retail experience, you have to constantly evolve. So this is not something that we're doing a one-time exercise. We have been actually improving retail experience in line with what we felt was the current state at that point of time over last 5 or 7 years. The shift is more significant here. But coming to a more substantive part of your question, the whole idea is this. If you look at the bottom of the pyramid in value retail, there is a fairly large number of competitors who are actually crowding that space. More are coming, selling clothes between 300 to 1,000 rupees, whether it's large number of online players or multiple offline players. Pantaloons over a period of time has delivered for a Indian middle class a good quality, reliable and reasonable fashion for its customers over a period of time. As the definition of good quality changes because a lot of product becomes available at lower price points, Pantaloons need to upgrade and justify and attract that customer to upgrade from cheaper products, lesser quality products to better, more reliable products. Because the brands are still further up and they are far more expensive. So this is what we're trying to do. In the journey, therefore, what happens? Your customer profile, which is wanting to get out of cheap products and looking for better quality, either in fashion or durability or any other functional property, starts to look at better options, and Pantaloons is well placed for that. It's a familiar brand and it offers that. In financial and economic terms, it obviously increases average bill size. It increases the gross margin because you're able to offer better product at slightly better price. And also, the other benefits in terms of cleaner display, customer convenience, and lower stock density, and therefore better entry terms, lower markdowns, all of which actually both financially and for customers create value. So that's the journey for us, and that's been the consistent path on which we've been following.
Okay, thank you so much, Ashish, for the very detailed answer. One quick follow-up. What is the interplay between the ethnic wear of Pantaloons and our TCNS products? So do we think of that as complementary, as competitors to each other, and do we sell TCNS products inside Pantaloons, or do we plan to?
The TCNS has been selling inside Pantaloons for 20 plus years. It's India's, W for example, is India's most successful, the largest ethnic wear brand for a long period of time, and Pantaloons has had share of external brands all the time. TCNS continues to be a part of it. If you look at Pantaloons' own business, close to 18-20% comes from ethnic wear. Of this, a significant part comes from Pantaloons' private labels. But there is a part which comes from external brands, and W is the number one external brand in Pantaloons. But it's not linked to our acquisition. It was so even before we invested in TCNS.
Okay, great.
I think there's nice complementarity about it. It enhances our understanding of the premium ethnic wear. Over a period of time, I think this will create interesting further possibilities for the company.
Yes, thank you so much. Thank you.
Thank you. Thank you very much, ladies and gentlemen. On behalf of the management, we thank all participants for joining us. In case of any further queries, you may please get in touch with Mr. Amit Dwivedi. You may now disconnect your lines. Thank you.
Thank you.